Alrighty, another day, another bailout. Today it appears it will be Credit Suisse, uh, whose credit default swaps have gone parabolic to the moon. Use whatever analogy you'd like. And if the cost of your credit default swaps are going way up, well, that means that you're on the verge of bankruptcy, or at least everybody thinks so. But have no fear, the Swiss National Bank has announced that Credit Suisse will receive a full backstop, which is a nice way of saying we'll never let you go bankrupt. Must be nice to be a banker. As I said yesterday, I think it's become increasingly clear that the banksters can't lose. In 2008, people were thinking, oh my gosh, what's going to happen when all these banks start going under and going bust? And then the bailouts came in and it was a surprise thing and it was only for certain people and blah, blah, blah. Now it's a given. Everyone assumes that the bailouts are coming. That is the moral hazard that we have lived with for the last 15 years, and this is the end result. You've got an unstable banking system writ large. Even Moody's, those one of those BS ratings agencies, even they are having to now downrank the entire U.S. banking system. But as we see with Credit Suisse, this is not limited to the United States. This is Europe too, and likely plenty of other places. This is just the nature of fractional reserve banking. It always ends in disaster. It's just a matter of how long you can kick the can down the road and keep the party going. It's a game of musical chairs. That's all it's ever been, going all the way back to, what was it, the 1700s. And so the question is, who will it be next? I guess maybe we're still looking at First Republic. That hasn't blown up yet. But as I said yesterday, the United States has pretty much announced that they're going to back up and bail out any bank possible. If you can lend against your securities at par, all that says to a bank is, hey, load up on treasuries, which might be part of the reason why yields are plunging, particularly at the short end of the curve. But hey, steepening at the yield curve could also just mean that we're right on the verge of the depression, worse is coming to worse. And when that happens, we always see an inverted yield curve rapidly steepen. But nevertheless, we're seeing yields plunge across the curve. I don't think that I saw any treasury across the entire curve last I checked today where the yield was rising. It seems the yields are down across the board. And honestly, if I were a bank of any kind, no matter how solvent I was, I would be pivoting into treasuries and agency MBS, because the Fed has said, hey, as long as you're in that, as long as that's what you've got on your balance sheet, we'll back you up. We will lend against that at par. And so it doesn't matter if those assets depreciate after you buy them. It doesn't matter if you buy them at a bad time. And so that's probably part of the reason why the next bank failure scare that we're getting is in Europe instead of the United States. But now, as expected, the Swiss National Bank announcing that they're going to bail out Credit Suisse. I don't think that anyone doubts at this point that no matter which bank starts to go out of business next, every central bank, wherever the bank happens to be, the central bank is going to pledge to step in and bail them out and make sure that nobody's allowed to go bust. And so, considering that, my opinion on what started all this, because a lot of people, I think, don't really have a theory. They just think that this happened out of the blue. To me, it's pretty clear this is just interest rate risk coming home to roost. This is kind of, this is why this is not shocking. Every time that interest rates go up, the banks run into trouble. If you hold assets, rising interest rates is bad for you because that leads to a depreciation of assets and an appreciation of cash, of money. When you have declining interest rates, that leads to an appreciation of assets and well, not necessarily, a relative depreciation. Although in our case, our cash is always depreciating. We always have positive inflation. Anyway, the cash. And so when that reverses, it's bad for asset holders. And who holds assets? Well, rich people and banks. An appreciation or a relative or a disinflation, let's put it that way, because it's not like the value of our money is actually going up. That's bad for the rich. The rich need constant inflation, not just because they want to keep you poor, but mainly because they want to make themselves richer. And the problem that they've run into over the past few years has been the zero lower bound. How do you keep lowering interest rates further and further once you get down to zero? And if your goal is to continue to prop up asset prices, that assets owned by banks and the assets owned by the very wealthy. Well, in Europe, the answer was negative interest rates, which hasn't worked out well. And so in the United States, we've just been bouncing off the zero lower bound and have managed to raise asset prices through psyops, mostly, since we hit the zero lower bound. But since inflation had gotten so out of hand and the Fed really was forced to, because, publicly, the public cover story for why we have a Federal Reserve is to protect the purchasing power of the dollar, which is pretty funny. We're supposed to have stable prices. That's the Fed's supposed mandate. That's why the Fed exists. In reality, the Fed exists to inflate asset prices. But the cover has to be something more altruistic, and so they say, oh, well, they're there to protect your purchasing power and create stable prices. And so when we had near double-digit inflation, obviously those are not stable prices, and so the Fed had to intervene in the most minimal way possible, and so they started hiking interest rates in 0.25% increments. I mean, just baby steps. But nevertheless, when you have such a fragile asset market that has been bouncing off the zero lower bound and has only been jawboned higher through psyops, it's pretty fragile. And so 2022 was not a good year to hold assets. Pretty much anything that you would have held if you had stocks or bonds, everything short of real estate, and even real estate is finally starting to take a turn for the worse, you would have seen a depreciation in your net worth over the course of 2022. And when everyone's so highly leveraged, particularly if you're a bank, well, that leads people to go bust. Because their business model only works when interest rates are moving in one direction, and that's down. Interest rates start to move up, people start to go broke. This is true across the system. So the Fed is going to have to give up on fighting inflation, because ultimately their true masters are not going to tolerate going bankrupt. And the Fed is going to have to cut rates back down to zero, because that's truly who the Fed works for. And so it won't matter if we have double-digit inflation. The Fed is going to be cutting rates to try and save the banksters and everyone who's essentially a part of the asset-owning class. So we'll see. I mean, I think that it would actually be bearish if the Fed cuts next week, this soon, because it'll show that the Fed truly is frightened. I think that if the Fed wants to show some strength, they'll still hike by 25 basis points, although I do think that is, I wouldn't call that the base case. I think the base case is no hike, that the Fed just says, hey, things are a little uncertain right now. Let's just hold tight and let's not do anything. That to me is very much Powell style. So with that said, I'm going to try and talk about something else tomorrow, because 3 days in a row, or 4 days in a row, I guess, of financial crisis stuff when it really hasn't hit the fan yet. We're just in the early stages, if that's indeed where we are. I think that's a little bit overkill for the senses. So unless something really interesting happens tomorrow, which, today we had the Credit Suisse thing, so I kind of had to touch on that. I will try and talk about something else, just to give my brain a rest from this stuff, because, I do follow it all day. And so, anyway, I'll see you folks back here tomorrow. We'll see what's going on.